The market has been all over the place in the last couple of weeks, and I think it's a great time to check in on the best growth ETFs with all this uncertainty. Should we consider dollar cost averaging into growth right now, or do we sit on the sidelines and wait for the storm to pass? In this video, we'll answer those questions and more by diving deeper into my favorite growth ETFs. I'm also going to share how I plan to invest in 2024 and beyond. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your net worth with simple, time-tested solutions. Please elbow that like button, subscribe if you haven't already, and drop me a comment down below with your favorite growth ETF or anything else that comes to mind as you watch this video. We have 20 new members this week. That is an all-time high. I'd like to give a new shout out to all my new members who are on the screen now, and a shout out to you members that have been here all along. My goal is to continue growing this YouTube memberships to add value to you as an investor to help you along your financial journey. I want to add an enhanced portfolio tracker eventually, also a light portfolio tracker that I personally use, along with many other nerdy spreadsheets that you can use along the way. These will always be in Google Sheets and Microsoft Excel form, so you can use whatever works best for you. I appreciate the support more now than ever with some recent happenings in my life. Thank you so much for sticking with me. And now you know what time it is. Let's grow. When to buy. Timing the market is the destroyer of wealth in investing. I can't tell you how many times I've seen people waiting on the sidelines with a huge pile of cash over the years. And I don't blame them. The news is constantly warning us about the next huge incoming recession. And guess what? The news is right. The market will crash. I can say this with 100% certainty. The problem here is that nobody can tell us when the market will crash. It could crash tomorrow. It really could. Tomorrow could start the next Great Recession. Or it could wait for 8.5 years from now. We truly don't know. Okay, so back on topic. When do we buy? The answer is always. We always buy. We need to keep accumulating shares of high quality, passively managed ETFs. They will continue to rise long-term when we zoom out over multiple decades. Waiting to invest until an unknown event happens is a loser's game. Think about it this way. The market has gone up on average by 10% per year over the last 100 years. And the data trends within 0.5%, no more than 1%, based on the market's mood and our sentiment, stays within the earnings trends over the last 100 years. So there's nothing mysterious about the ultimate value of the market. It does a lot of this with our human emotions, but the trend of going up 10% isn't random. That's the growth of businesses. It's like this. Say we have a coin that lands on heads 55% of the time. Heads, you make money. Tails, you lose money. You want to play this game right now with as much money as possible. Long term, you are going to smoke the house. But I do agree that buying at the right time and at the right price is important for our wealth accumulation. So it's not a good thing to buy shares at random based on what our gut is telling us. My system has a 100% chance of never buying at the wrong time. And I guarantee this to be true for multiple decades moving forward. And if you've watched my videos, you're probably pretty confused right now. You know I'm not a guy looking for clickbaity, make a quick buck type action. So what gives? Let me show you. This is a target allocation spreadsheet that I threw together, and it's a really simple model. I'd like to note a couple things. Let's say you have $100,000, and right now it's in cash. Whether you lump sum this entire amount into your target allocations, into your portfolio, or you dollar cost average in, like say you only want to do 1,000 a week for the next 100 weeks to get the money in ultimately. The portfolio target allocations are based on a percentage, so it will work in the exact same way as far as your future purchasing decisions. In this case, let's just say we dump all 100,000 into the portfolio, or said differently, you currently have $100,000 in your portfolio. And so this right here shows that you want VGT to be 35% of your portfolio, regardless of how big it is. You want it to be 35%. And then you go down the line, VU, you want it 30%, SCHD, you want 25. Now you could have 3 holdings. You could have 100 holdings at 1% each, or one at 0.5 and one at 2.3. It doesn't matter. This is just your target allocations. So the amount of money doesn't matter and how many holdings you have doesn't matter. It just has to add up to 100%, of course. If these are my target allocations, let's say down here I have things happening to the market. Let's say we run into a big crash, because that could very well happen, and VGT drops down 35%. So it's now, without putting any additional money, this 100,000 is now only worth 87,000. Same portfolio, you haven't made a move yet. And the market would also drop, most likely, say 15%. SCHD might drop 5%, and your cash equivalents are going to stay about the same. So what this shows you now, you'll notice VGT turned green. It's the only one that's below its target allocation. Now, VU crashed as well by 15%. So you may be thinking, how is it above its allocation? But VGT fell by so much with the tech crash that everything else is technically higher than it's supposed to be based on the target allocations. I like to start with cash. Cash is now at 12.2%. That's above our 10% goal. So what we need to do is put money into the market, into our holdings, to get cash back down to 10%, aka we are buying the dip by default. And it looks like we need to buy VGT to get it back towards its 35%. If we dump a big chunk of money into VGT, it's going to get it back to target allocation, and then VU and SCHD are going to be below their target. So this will tell you what to put money into. But let's do the flip side. Say the VGT, like lately, the last year has gone up 50%. Wow, it's way over now. The market, will say, has gone up 25%. SCHD a more modest 10%. When you had 100,000 in there without putting any additional money in over the last year or so, let's just say, you're now at 127,000. Guess what? Your 10,000 cash, which didn't change, it might go up a little with the high yield savings account, but we'll just say it didn't change here. You're now light in cash. So when you have new money coming in from your work to dollar cost average in, you're going to dollar cost average into your cash position to get it back up to 10%. It always takes priority. So that is when to buy. If your cash is low, naturally, reinvest in cash equivalents, money markets, high yield savings. If your cash is above 10%, put it in this case, you would put it into SCHD and VU because they are below. VGT, and this is what's happened in reality to me, VGT is above its allocation because it's performed well, so you do not buy VGT. My favorite growth ETFs. We're going to open the spreadsheet that I use to compare ETFs before making purchasing decisions. And this is just a nice starting point for researching the best ETFs in each category. And I should also note that this spreadsheet that we're about to see is out there for the channel members in Google Sheets and Microsoft Excel form, depending on your preference. We're going to start on my long-term tab, and that's just the tab that pulls the 10-year total return. We also have a medium length tab, mid-length, that has a 5-year total return, and a short-term tab that has 3-year total return, and some other different metrics. Let's start on the long-term tab. What I've done out here is I've already filtered for growth, and what we have here is assets under management, just to make sure it's well-funded, how many holdings it has, you can see how diversified it is, the top 10 holdings percentage, how top-heavy they are. So I'm not gonna get too into the weeds on this stuff, but it's there if you wanna look as a member out here, if you're comparing funds. It has the expense ratio information, along with the dividend yield and 5-year dividend growth rate. Again, these are growth funds. I use this mostly for the dividend role, but I do think it's important that these growth funds also are stable companies that continue to grow their dividends over time. Gotta have that net income to support the whole business model. That said, I'd like to quickly sort by yield. So SOX up here, it's a semiconductor one, 35 holdings, has grown its dividends by 12% over the last 5 years. That's impressive. QQQ, there's our NASDAQ 100, 10.5, VGT at 8.75%. XLK, which is very similar to VGT, is right in there at 8. I will note that SCHD is -2, and I did confirm that number, so that's a little discouraging for one of my favorite funds. We're going to highlight that one later. But what we really care about with growth is the total return. And we can see, oh man, I'm reluctant to buy SMH, which is another semiconductor only one. It has 26 holdings. I think it's the top 25 semiconductor companies. And once again, it is just smashing the 10-year charts. SOX is another, similar holdings. So the ones we're going to look at more, XLK is the king at 567% over the last 10 years. IYW and VGT come in right behind it at 561 and 553. And then QQQ is a little over 466, but we're going to zoom out more later. I just wanted to touch on some of these returns. SCHD is also a solid 351. Let's highlight the short-term tab as well. So a lot of this information will be the same, on all the tabs, but the 3-year total return is looking great once again for the one that's eluded me because I'm too scared to be that concentrated. SMH at 78%. Its buddy SOX right up there too. XLK is the top one that I consider with growth investing at 49%. IYW and IWY, not to get confused between the two, 45 and 38%. VGT right in there at 38 as well. And QQQM and QQQ, they're the same thing. QQQM with a slightly lower expense ratio is 33%. So they're all right in there. And we're going to dive more into this in Seeking Alpha. I just wanted to show that this is a nice high-level spreadsheet to compare some of your favorite ETFs by type. A lot of times I'll start here and then I'll narrow in on some tickers and go out and dive deeper into the data on Seeking Alpha. Before we move on, I jump back over to the long-term tab here with the 10-year total return. And I wanted to quickly highlight a few things that differentiate some of my favorite ETFs. So SMH and SOX are both all semiconductors, and I don't have a ton to say about those. They performed incredibly well. They're just a bit too concentrated for my blood. XLK and VGT are very similar funds. They're both 100% tech, and they have a 79% weighted overlap. XLK concentrates into 68 companies, only the big boys, whereas VGT has 318 companies. And you can see VGT is 60% in its top 10 holdings. XLK is 67%. So the difference is, basically, to summarize, this is VU and this is VTI of the tech sector. This pulls in a lot more companies, some small and mid. This is just the big boys, much like the S&P 500 only pulls in 500 compared to the total market's 4,000. So the logic is similar. VGT is less concentrated, but they are 80% the same. So I prefer VGT, ironically, in tech. I like to get a little spread to get the up and comers. Whereas, as many of you know, I prefer VU, the XLK equivalent in this case, for my cornerstone. I like the concentration of just the biggest 500. I'm comfortable with that business. But I just wanted to point out XLK and VGT and VU and VTI are all great, and there's no right or wrong way to go. You'll see when I zoom way out 20 years what I'm talking about here. It's been a comparative bull run for XLK, and you'll notice it's a bit higher than VGT on a lot of these things, but that's just been the last 10 years. When you zoom out, things get a little more interesting. It's time to declare a winner in the next section. Comparing the big dogs. We will be using Seeking Alpha to compare the top growth ETFs over a variety of time periods. And then we'll take a look at a back test to see which one of these ETFs actually would have dominated a realistic dollar cost average strategy over the last many years. Are you ready for this, my fellow nerds? Let's get it. We're out on the charting tab of Seeking Alpha, and what I have pulled up here is total return. So this includes price appreciation and it includes all dividends paid. And I'm currently set to year to date. So we're looking at what's happened so far this year. I tried to get a good variety of tickers. I didn't necessarily just put in the best this time. I replaced SMH, which I love, and you guys saw it performs very well. I replaced it with MGK because I get a lot of you asking about MGK and how it compares with the big boys. So we have VGT and XLK. These are my two favorite tech ETFs. I roll with VGT, as I explained earlier, but XLK is great too. And then we have QQQ and SCHG, and these are my two favorite multi-sector growth ETFs. And then I have VUG, which is very popular, and it's the oldest of all of these, and I know a lot of people have it. And MGK, just to throw a new one in the mix. And you'll notice I have SPY hiding over here. We have to scroll a little each time, but I just want to show how well growth does over time compared to the market. So this is basically VU. This is the S&P 500, but this is the OG. So it has more history, much like QQQ has more history than QQQM. So I grabbed more tickers like that for this situation. So as you can see, year to date, VGT and XLK are lagging the growth market by quite a bit, and QQQ is just ahead of them at 5.4%. SCHG has been very nice. It's been the best, actually, at 8.69%. Very nice. And VUG and MGK are right there in second place. Now, so far this year, in 2024, the market has gone up by 6.36%. So the market's right in between. It is beating the tech ones, and it is beating QQQ, which is surprising. But that's how we're looking so far year to date. Let's just zoom it out a full year. So over the last 1 year, and I should mention, I cut it off because I zoomed in so you guys could see as much of the screen, but this data is as of 4/16. The market's been pretty brutal lately. This might not be perfectly up to date when you're watching this video. So over 1 year, VGT is at 33%, XLK is overperformed at 36%, and we knew that. The big companies have done better than the small and mid. QQQ is right between them at 36%. SCHG, once again, is the king at 38%. Very impressive. I've been watching this one, I really have. And VUG and MGK are right in the mix at 35 and 37. Now, the market during this time is only up 24%. So all the growths that we are looking at here are ahead over the last year over the market. Let's zoom it out 3 years and see if things get a little more interesting here. VGT is up 33% to XLK's whopping 44%. So the big companies have dominated the small and mid-size tech companies. You know, basically VU, in quotes, has dominated VTI in the tech world over the last 3 years. QQQ is right behind VGT by about 5%. SCHG is still ahead of what I consider its rival QQQ. These are very similar makeups, much like these two. So SCHD has the year to date, the 1 year, and the 3 year lead on QQQ. It's very interesting. And VUG is at 23%. It's lagged a little bit. And MGK, a solid 26%, right behind these two balanced ETFs. And the market has been up 26% as well, so it's right in the mix when you zoom out the 3 years. Over the last 5 years, we see that VGT has been 152 to XLK's 175. Same story there going. And QQQ is ahead of SCHG when you zoom it out 5 years, 139 to 127. And then VUG and MGK are 115 and MGK is 125, so looking pretty solid here. And the market is up 89% during that window. So the growths are separating themselves over 5 years. Now we're gonna scooch it out 10 years. VGT is up an impressive 531%, XLK a slightly more 544. QQQ has dominated SCHG over the last 10 years, 456 to 332. And VUG is coming in short of MGK, 328 to 307. You can see these ones don't compete with the big boys over time, but they have all crushed the market's 231%. So that's where you start to see the separation in the last 10 years. And now we are going to zoom her out 20 years to see what these things look like. We're going to lose a couple tickers here due to them not being around the last 20 years. Okay, I paused the video because I put in the last 20 years. I did from 4/16/04 through 4/16/2024. You can see that's 7,294 days on here. I really wish it still showed the date range. Oh, it does. Okay, since 4/19, so it looks like maybe that was a weekend or something. So from 4/19/2024 on all of these, you can see they've existed that long. I had to get rid of everything that did not have 20 years. I threw in IYW, a Russell 1000 tech ETF. It's a great one. And I also threw in the total market, VTI. So over the last 20 years, you can see that VGT has slightly outperformed XLK. It's interesting, right? When you zoom out, we've had some small and mid domination and some large domination. Remember, these are 80% the same, but this is VTI. When the small guys do well, VGT does proportionally well. When the big guys do well, XLK dominates. So they're both very good. And then the Russell 1000 version has been coming right behind these two. QQQ, the NASDAQ 100, has actually outperformed all of the tech-only funds during that time. And VUG, a lot of people's favorites, it's a nice balance, but it falls quite a bit short over the last 20 years. Still beats the market though, SPY, at 555% returns. And you look at VTI, and it has a juicy 556. When we zoom out, the reversion to the mean really does play out. And I've been asked so many times, why VGT over XLK? You're just throwing away money. XLK dominates. You're right. It has dominated lately. VGT dominated before. When you stretch them out, they're both great. And I kind of wish I had a little QQQM. Let's call it what it is. This is a well-balanced NASDAQ 100 index that's outperformed both of them. So they're all great, you guys. These tech funds have done a great job over 20 years. It's actually even more extreme. Unfortunately, I can't do it on this tool, but it's even more extreme over the last 40 years. Tech has been even better. You can compare the NASDAQ 100 index, which has existed for 40 years, versus the S&P 500 index, which has existed for a lot longer than that. The NASDAQ 100 obliterates it. And again, that is including multiple recessions. That's why I say when things are looking rough with these tech ETFs, and they will crash, VGT, XLK, these will absolutely fall face first at some point in time. Don't run, don't panic. Be greedy when the others around you are fearful, and buy more. You'll thank yourself later when you zoom things out. It's time for my favorite part of the video, the portfolio visualizer backtest. So for this one, we're going to pull as much data as possible. So I'm just putting in the full date range, include 2024, yes. We're going to start with $10,000 and we'll be contributing $1,000 per month. We want reinvest dividends on and display income on. So what I did, you guys, with no bias, on that last 20-year view, I took the best performers. And of course, I had to put my favorite on top, VGT. Of course, it's the best by far and away. I'm kidding. XLK is portfolio 2 at 100%. And QQQ, the NASDAQ 100 index, is portfolio 3 at 100%. And you can see I had already hit go, and it's unfortunately because of VGT's age. We're looking at 2005 through March of 2024. So almost 20 years. That's still a nice chunk. When you come down here, you can see, oh, she is a close one. I'm actually just looking at this for the first time myself. With the 10,000 initial investment and 1,000 a month, VGT is the highest at 1.733 million. XLK is basically tied at 1.727 million. And QQQ is right there at 1.634 million. You can see their CAGRs are similar. The best year is the best with VGT. The worst year is the worst with VGT. Interesting, but I guess that makes sense because small and mid, by their nature, are a little more volatile than the large ones. So that actually makes perfect sense. So as you can see here with the annual returns, we are pretty much on par every year. Looks like VGT is a bit more extreme on the lows and the highs. With the small and mid, that's bound to happen. It's much akin to VTI compared to VU. Yeah, that's a fairly steady trend, I would say. So really, you can't go wrong with any of these. It looks like tech was a little better in 19, but then in 2020, things flipped back a little. We know last year the bigger companies were a little better. We've seen that with the charts and XLK pulling away lately. And then so far in 2024, we're pretty close here. And again, this is only through March. We saw different numbers because my Seeking Alpha stuff was a little more up to date. This is just through March. So when we come down to the annualized returns, in the last 3 years, XLK has dominated at 17.2% to VGT's 14.3 and QQQ's 12.4. In the last 5 years, it's a little closer, but you still have XLK ahead at 24% and then 22 and 21 respectively for VGT and QQQ. Over the last 10 years, it's pretty close, but you still have that XLK win. And The NASDAQ 100's lagged a little bit. And then the full time, we're so close here, you guys. It's slightly VGT in the lead over the almost 20 years. I'm very selective with the sponsorships that I'll take on this channel, and you'll see what I mean moving forward. If it doesn't directly relate to finance and truly benefit you, me, everyone involved, I won't take the sponsorship. With that said, I really do highly recommend Seeking Alpha. I've used it for a long time. I use it to aggregate my portfolio. I use it to read a lot of different articles, to research stocks and ETFs. It's my main screener that I use to select things for the Dividend Snowball and the HODL Factory, my individual stocks. And of course, the more obvious thing, it's how I research the returns, the dividend history, and things like that about all these stocks and ETFs. So I really do genuinely highly recommend it. And if you want to try Seeking Alpha Premium for free for 7 days to see if it works for you, then there's a link in the description below. If you like what you see, you will save 25% off your first year, no additional cost to you, and it really helps support the channel. Stay the course. Growth ETFs are by far and away the hardest investments to stick to the system with. The extreme highs and lows are more difficult to handle emotionally than the more stable nature of something like dividend ETFs. With dividend ETFs, even when the price is falling, we all know that the dividends are based on a per share basis, and generally speaking, they always go up. So even when we're losing that value, we see that cash flow coming in over the years. With growth, when they go down, it just hurts that little bit extra because you don't have the dividends, for the most part, flowing in the same way. So it feels like a loss. But just know, when growth ETFs crash, not growth stocks, because anything can happen to an individual company, but when growth ETFs crash, just keep on buying, because eventually they'll hit all-time highs. They always do. We might have to zoom way out, but if you're buying all the lows, all the highs, all the lows, eventually your average cost will look very nice. Sticking to your target allocations will work over many years. It's one of the few things that is not a mystery in investing. My purpose of being here and making these videos really is simply to help you towards your version of financial freedom. I'd just like to give a big thank you for all the extra support I've received this week. It means a lot more than any words can describe. I'm not going to plug any videos at the end of this one. Use this extra time to reach out to someone you care about and ask how their day was. Thanks for watching, and I will see you here next week. Peace.